Imagine your pension fund just sent you a notice. It says you received a distribution from one of its private equity investments. That feels like good news. It feels like the fund sold something, made money, and now you're getting your share. Except in a growing number of cases, none of that happened. No company was sold. No profit was realized. What actually happened is the fund borrowed money against assets it still owns and mailed you a check with that borrowed money and called it a return. This isn't one company doing something shady. This isn't a Ponzi scheme or a single bad actor. This is a structural feature now built into a multi-trillion-dollar industry, and almost nobody outside of it has ever heard the term for it. It's called NAV lending. And once you understand how it actually works, you'll start to see why some of the best-looking returns in private equity right now might be some of the least real. To understand why this exists, you have to understand the problem it was built to solve. Private equity used to run on a simple loop. Raise money from investors, buy companies, grow them for a few years, sell them, and send the profits back to your investors. That last step, selling the company and sending back cash, is called a distribution. And for most of the 2010s, that loop worked fine. Buyers showed up, IPO windows opened, deals got done. But over the last few years, that exit machine has basically stalled. Higher rates made buyers more cautious. IPO windows opened and slammed shut. And the result is that private equity funds are now sitting on roughly $3.8 trillion worth of unsold companies, according to Bain & Company's research on the industry. Average holding periods have stretched out to around 7 years, way longer than the typical fund was ever designed for. And the actual cash going back to investors, measured as a percentage of the fund's value, has been stuck around 11%, compared to a historical average closer to 29% in the years before. So picture being a pension fund. You committed money to these funds a decade ago expecting a steady drip of returns coming back over time. Instead, that drip basically dried up. And that's a massive problem, because pension funds, endowments, and insurance companies don't just want their money to grow on paper. They need actual cash showing up so they can pay retirees, cover obligations, and reinvest into the next fund when their favorite manager comes knocking. So if the cash isn't coming back through normal exits, something else has to produce it, which brings us to the workaround. A NAV loan, short for net asset value loan, is when a private equity fund borrows money not against a single company, but against the entire value of its portfolio. Think of it like a homeowner taking out a home equity loan. You haven't sold the house, but the bank will lend you money against what the house is worth on paper. Private equity funds are now doing the exact same thing, except the house is a basket of companies that don't trade on any public market, and the appraisal is done by the very same firm that's borrowing the money. Here's how this actually plays out for someone like Karen, a portfolio manager at a mid-sized pension fund. Karen committed $50 million to a private equity fund back in 2018. The fund bought a handful of companies, grew them, and by 2023, Karen still hasn't seen much cash come back because none of those companies have sold. In one quarter, Karen gets a distribution. The fund tells her it returned $8 million in capital. Karen is thrilled. Her internal rate of return on this investment just jumped. Her boss is happy. Nobody asked where the $8 million actually came from because on the surface, a distribution is a distribution. But behind the scenes, the fund didn't sell anything. It took out a loan against its own portfolio and used that borrowed money to pay Karen. Karen's fund now owes money it didn't owe before. She just doesn't know it yet because that debt sits at the fund level, not on her statement. Now, to be fair, most NAV loans aren't actually used this way. According to data from NAV Lender 17 Capital, roughly 89% of these loans are used for what the industry calls money and purposes. Things like funding add-on acquisitions for portfolio companies or protecting an existing equity stake from being diluted in a new financing round. Those are genuinely defensible uses of leverage. But that leaves a real and growing slice of the market, the money-out purposes, where the loan exists purely to manufacture a distribution and pay investors with borrowed cash instead of real exit proceeds. And the reason that slice matters so much more than its size suggests is timing. It tends to show up right when a manager is heading back out to raise their next fund, because nothing helps you raise new money faster than telling prospective investors your last fund already returned a healthy chunk of cash. And this is where the mechanism becomes less about liquidity and more about optics. A fund's track record is largely judged by a metric called DPI, distributions to paid-in capital. It's the ratio that tells investors how much actual cash has come back versus how much was put in. A fund sitting on $3.8 trillion of unsold paper gains has a DPI problem, because paper gains don't count, only cash does. But a NAV loan can manufacture cash on command. Borrow against the portfolio, pay it out as a distribution, and suddenly your DPI number looks dramatically healthier heading into a fundraise, even though nothing about the underlying companies actually changed. The portfolio didn't get more valuable, it just got more indebted. And here's the part that should actually concern you if any part of your retirement money flows into private equity, which, if you have a pension, it almost certainly does. NAV lenders don't sit alongside investors in the capital structure, they sit above them. It's what industry skeptics have started calling leverage on leverage. If the portfolio companies underneath this loan lose value, the NAV lender gets paid back first, in full, before a single dollar goes to the limited partners, meaning your pension fund. The loan-to-value ratios on these facilities are typically kept low, somewhere in the 5 to 30% range, specifically so the lender has a wide cushion before they ever take a loss, which sounds responsible from the lender's side. But flip the perspective. That cushion the lender built for themselves is coming directly out of the equity that was supposed to belong to you. So now let's run the full chain of dominoes, because this is where it stops being a footnote and starts being a system. Rates stay elevated for longer than expected. Exit markets, IPOs, and M&A stay frozen because buyers don't want to overpay in a high-rate environment. Distributions to investors stay stuck near record lows because nothing's actually selling. Fund managers need to raise their next multi-billion-dollar fund, and investors are now asking harder questions about real cash returns instead of just paper markups. So managers turn to NAV loans to manufacture a distribution, which makes the DPI number look healthier than the underlying business actually is. New investors commit capital based on that improved track record. The portfolio now carries fund-level debt stacked on top of whatever debt already exists inside each individual portfolio company. And if valuations crack from here, the NAV lender gets repaid first in full, and the loss gets absorbed entirely by the limited partners sitting below them. The system isn't lying exactly. Every step is disclosed somewhere in a footnote nobody outside the industry reads. It's just being presented in the order that makes everyone look the best. And the scale here isn't small anymore. According to S&P Global, there's now roughly $150 billion in outstanding NAV loans, and multiple industry forecasts expect that number to keep growing toward $150 billion in annual deployment by the end of this decade. This went from a niche tool a handful of distressed managers used during the financial crisis to a mainstream piece of financial plumbing that most large private equity firms now have access to. And the reason you've probably never heard the term NAV lending is the same reason none of this gets covered the way a stock crash does. There's no single villain. There's no ticker symbol to blame. It's not one company committing fraud, it's an entire industry quietly agreeing on a financial structure that makes everyone's numbers look better in the short term, as long as nobody asks what's actually backing those numbers. It doesn't trend on social media because there's no dramatic headline. The headline would have to read something like, "Private equity funds are increasingly using fund-level debt to pay investors with borrowed money instead of real exit proceeds," which, again, doesn't exactly roll off the tongue. So here's where this actually leaves us. NAV lending itself isn't inherently a scam. Used the way most of it is actually used, for add-on investments and protecting good assets, it's a legitimate tool. But the version of it used to manufacture a distribution right before a fundraise isn't financing anymore, it's stagecraft. It's borrowing against tomorrow to make today look finished. And the people holding the bag if those underlying valuations are wrong aren't the banks issuing the loans. They're the pension funds, the endowments, and ultimately the retirees and savers sitting at the very bottom of a capital structure they never agreed to be subordinated in. If you want to actually understand how money really moves before it shows up in a headline, hit subscribe. Because this is exactly the kind of mechanism traditional financial media skips past. The boring structural stuff that doesn't trend, but ends up determining who actually gets paid when things go wrong. Because the truth about most financial scams isn't that someone broke the rules. It's that the rules were written so well, nobody had to.